Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Welcome to the podcast. This is the Fast 50 Unveil, a special series of podcasts as we release the 2025 report, where to put your money today for the best capital growth in 2025. This thing's flying off the shelf. This is the fourth instalment of this series of 6. I hope you've tuned into the first couple, and you're probably sitting there getting a bit annoyed with us because it's been very cagey around what suburbs actually made the list. We're talking around them rather than about them, and we'll talk a little bit more about them. Stay with us. The idea being is to be that frustration thing, like when you're watching TV and you just want to know the outcomes and they flick you to a commercial break. If you want to know what's going on, go and download the report. And a lot of people have been downloading it, so much so that it broke the internet at a point in time. I think there were some challenges on the mobile downloads for a point over maybe about 12 hours one evening. It's all fixed. So if you had that problem, go back, download it. It's there. It's available. There's so many people actually did it that it was a server overload. So, you know, the good thing is that it's in demand. It's in high demand. Seems to be resonating with people and the feedback we're having around it. The negative is probably maybe for some of you a less than favourable experience. So my apologies in that regards. Go and sort it out. The relevant team members who were in charge of making sure that the internet was powerful enough to do this, akin to when Kim Kardashian broke the internet. We've had a regroup. We've worked out what went wrong, and hopefully it won't happen in the future. So bear with us. Go and check it out, smartpropertyinvestment.com.au. It's impossible not to find it. Just go to the website, click on a button, download it, immerse yourself in it. The fastest 50 growing suburbs, where to put your money today for 2025. And the report coming back from the Fast 50 is maybe it's not in regional locations. That's what we're going to talk about today. Joining me back in the studio, the partner of the Fast 50 report, Paul Glossop. He's the CEO of Pure Property Investment, the 50th best property investment strategy company in Australia.
Mate, when I started, I don't think there was anywhere near 50 companies in Australia.
So you're ahead of the game.
I started at number 1 and moved my way to number 50 because I was the first, maybe. That's how it worked. I appreciate the kind introduction, as always.
I do my best. And
thank you.
The point being, your partnership with the report is key. You've been integral not only in working with myself and my team here in developing the methodology of it, and I think it's pretty sound. And we caught up probably a couple of months ago, and we sort of interrogated the previous report, the Fast 50 for 2024, and our scorecard looked pretty good by memory.
It did indeed. And I guess to recap on that, if anyone hasn't listened to it, go back through the first and probably second episode that we dropped a couple of days ago. And realistically, I think we sort of reviewed where the best 10 performing markets across Australia were out of over 10,000 suburbs as per CoreLogic's data for 2023. And we're very pleased to note that 4 out of those top 10 were in our top
4
50.
or 6?
4 or 6 rather. 6, yeah. No, sorry, 6 out of that were in the top 10 and in our Fast 50 report, which we launched last year.
So the point we made was maybe how we've gone about doing this is the right way, and we've kept consistent. In the 2025 report with the methodology for 2024, we went out to a whole bunch of experts. I don't need to go over it. You can go and tune into it. A whole bunch of experts said, where do you reckon, which areas are going to have the best, which suburb, not postcode, which suburb is going to have the best capital growth for 2025? We put all together, did an overlay data, and we come out with this year's ranking. The point we made was we got it pretty right last year. So does past performance indicate previous performance? We make no guarantees whatsoever. If you make any decisions around this report, it should just be part of a framework of how you go about assessing where you should be investing properly. Hopefully we've got it right. Hopefully we've done a pretty good job, but can't guarantee anything. And that sounds a bit glib, but this is the way it works with this sort of stuff. Hopefully this is a good guide for you. We'll have to do another report card next year to see how we go this year. Maybe we do better. Maybe we do worse. I don't know. But we've tried our best.
We definitely have. We
have tried our best, and as the team has as well. Now, we did this last year in our debrief around the report, and I'm a big fan of debriefing. So you got information and you know the facts. Okay, well, debriefing. What do you do now? How does that sort of shape and change the way in which you're going to make decisions? What sort of more information do you need to get greater currency or greater agency around your decision making? All this sort of comes in. So part of the debriefing thing is, okay, what next? What do we do? how do we go about doing it? We spoke about it last year around the performance of regional markets as part of this Fast 50 report, looking at the numbers, looking at the data coming out from this year's report. And when I sort it, and I'll go through this very, very quickly. So this is the Fast 50. Now, remember, there is the initial shortlist of this. So our experts come up with, by memory, about 140 suburbs, right?
Correct.
So this was 10,000 suburbs in Australia, which our experts got to about 140. That's pretty heavy lifting. So I would argue that all those 140 are probably pretty good. And the next time we meet Paul tomorrow, we're going to talk about those suburbs that didn't make the list. However, they're all still very good places to invest in.
Yeah.
So of the 50, looking at not at the postcode level, but at a division level, of the 50, there was, my peepers aren't that good these days, there was 6 in Adelaide. There were, and this is the division level, there was 5 in Brisbane. There was 2 in Melbourne. There was 1 in Outer Adelaide, but I'm probably going to call that's probably more regional. That's, I can't even say it, Niraputa. Did I get that right?
That's pretty close.
Niraputa? What's Niraputa?
There's not an Adelaide accent or a South Australian accent attached to
That's
that.
a Niraputa.
That's more South. That's out of quite South African then. We'll continue on, mate. Push on.
Then we've got Perth. Now, Perth racked up 25. So 25 out of 50. 50% of the Fast 50 is in Perth. And then there was 2 in Sydney. So the rest of that, which is, and I've got my computer out here, I'm going to call Outer Adelaide regional. A couple in the Hunter, 1 in Goulburn, 1 in Fitzroy, 1 in Eyre. That must be the Eyre Peninsula, correct?
Mm-hmm.
2 in Darling Downs. 9.
9. So, call it maybe touch under 20% of the top 50. And I think
9 in a regional location.
9 in regional locations. And some of those, depending on where you live, you might question whether certain markets are regional or not. And we had this discussion last year. I think one thing to probably just reinforce here is that going back to the methodology is, I know Pure Property's involvement in this is, whilst we aren't necessarily advocating that everything in the top 50 are markets that we put forward, I think the cross-section of all of the different both buyers agents as well as economists and strategists who've lent their lens to this have different opinions, and I think depending on the timing, some of these markets will do better than others. But 20% is effectively where it sits.
Smells about right, and some of those like Kearney Spring is in Toowoomba, right?
Correct. Yeah, which is still it's a large regional town.
It's a large regional town.
Yeah,
but it's regional.
Correct.
So the sort of 80% of these are in capital city locations.
Correct.
Perth, Brizzy, Adelaide, handful in Sydney, handful in Melbourne. So I'd sort of expect that. There's a couple there in the Hunter.
Yep.
Belmont and Katara. I don't know where Katara
is. Newcastle.
Kotara.
Yeah, so it's pretty close to Newcastle proper.
Okay, so but it's still out. It's still in the Hunter.
Yeah, correct.
But it's Newcastle's metropolitan.
But I mean, look, it's still top 10. It's top 10 largest city in Australia, but deemed to be. It's not a capital city, so it's deemed to be essentially potentially.
That's
Sunshine Coast in general is also deemed to be a regional market. So you can define these things a little bit differently depending on what you're looking at.
And you got to be careful with it as well. So one of the best ways to do it is look at the economies, the population sizes, the diversity of the economy, the manufacturing heartbeat of these places. And as far as I'm concerned, Newcastle's a metropolitan location.
Yeah. Yeah, and
Wollongong is a metropolitan location.
Yeah.
Geelong is a metropolitan location. Ballarat is a regional location. Gold Coast is metropolitan
location.
And you see, you see pockets of this, and you can get into it. You can go to Australia Post, and it'll tell you who's metropolitan, who's regional, and that's normally sort of working out how much it costs to post stuff there, right? Which is the way. But mate, there's a lot of posters, mate. But Australia Post doing well these days. It's just delivering stuff all over the joint. You're not big on regional stuff, are you?
Well, this is where I guess it's quite interesting, because I know we're opening up this conversation today in this Fast 50 report to say, look, about 20% of these locations in this report are regional. And if I look through not necessarily this report, but if I look through data and I sort of assess what we've bought and where we've bought over the years, I can unequivocally say that as a company, Pure Property Investment have certainly bought in what's deemed to be regional markets over the years. And we technically are still buying in what's deemed to be regional markets. The reality, though, is that it's certainly a horses for courses approach. And when I say that, I mean not to be flippant, but if you're on a relatively limited budget and you need to potentially achieve slightly above average yield to ensure that you can hold the asset as part of early stages or for a separate reason, full stop, more often than not, regional locations are lower in price. And I say more often than not. I'm not just suggesting that they're all cheaper, but some, and majority compared to major metro markets for the equivalent property, are cheaper and typically slightly higher rental yield. Now, I guess the common, probably not necessarily misconception, but the opinion is that because they're cheaper and because they're higher yields, that they underperform from a growth standpoint. And that's certainly not true. I mean, I'm not here to suggest that you buy metro only because that's what's going to give you better 10, 15, 20-year growth. And I can recite a bunch of markets that we've bought in over the years, and in no specific order, but markets that I can think of such as Bundaberg, and Bundaberg probably 2, 3, 4 years ago, markets such as Burnie, markets such as Devonport, markets such as Launceston, markets such as Victor Harbour in South Australia, Geelong, which we were buying in probably 7 or 8 years ago, Wollongong, which potentially was deemed to be a regional market 7 or 8, 9 years ago, Newcastle the same, the Hunter Valley the same, parts of the Sunshine Coast, parts of the Gold Coast, down south towards the past Mandurah, Albany, Bunbury. These markets are few and varied in between, but there are certainly markets that we're bought in. But I'd probably also suggest that there's markets that have their time, both good and bad, and it's like anything. Right now, we're probably suggesting that there's certain areas in major metro markets which are probably going to have a stronger, more consistent run over the next 2 to 4 years versus where the regional markets were. And I think it doesn't take anyone who's listening to this is no doubt interested and potentially invested in property. And if you were in this game start of COVID, you would have 100% seen all of the data and all the news and everything else that happened around the exodus of the mass cities for a period of time. Between 2020 and 2022, regional Australia had its best time on record when we're talking about demand for property.
Well, a place like Byron Bay had 60% jumps in property values.
Places like Kiama, places, if we're talking about Sydney, places on down towards Portsea in the Melbourne markets and over towards the Mornington. And then if you look at every major city had those sort of 2, 3, 4 hour markets, which were very, very nice lifestyle markets. And the justification was there at the point in time for the requirement for where you work as well as the price of money. And then ultimately regional markets have limited supply, and ultimately property, you can't build it overnight. So when there's a lot of people all of a sudden want a product and they want it en masse, markets go up in value both for sale and sale price as well as rental price. And also we obviously saw the holiday home phenomena where people could only travel domestically and a lot of the time interstate to actually go down that pathway. So we saw this Airbnb absolute boom in some of these more premium markets, which has certainly probably subsided and probably going to be normalising, I think, for another 3, 4, 5 years. In some markets, it's busted and busted pretty hard. But for the most part, it's sort of had a quasi soft landing. I wouldn't say soft landing, but it's quasi soft landing.
Quasi soft landing, but I think a lot of these soft landing or the harder landing for some of these areas, and we've spoken about this beforehand, is government intervention has forced the hand of a lot of regional markets, particularly when it comes to property investment and those who invest in property for the purpose of Airbnb or short-term stay stuff. So it's been regulated now. I'm probably going to get the numbers completely wrong, but in places like Byron Bay now, you can only short-term accommodation. Is it 60 or 90 days?
I believe it's. I think it might be 60. I think
days.
it's 60. I think it's 60.
So
a year.
A year. Yeah.
Correct,
So you're absolutely mandated to how often now, because the point being they're saying, well, we need to make housing available at a rental level for people that want to be permanently in these areas. So they're regulating it, right?
Yeah.
And that's taken some of the steam out of these regional markets for the purpose of property investment.
Yep.
And some people still might want to keep their holiday home in Byron Bay or elsewhere. But it's not largely now for the purpose of generating income from it. It's probably more of a lifestyle asset with potentially helping to underwrite some of the costs to hold it through 60 days or 90 days, whatever it is. a year, and that will change. That's the supply and demand equation that you spoke about, and therefore it will change the appeal of these areas and have a negative impact on price value growth or sustaining those price values.
Yeah, absolutely, mate. And I think, look, probably going on that theme of Byron or the northern rivers of New South Wales, I mean, if I asked you the question, Phil, say 3 years ago, and I actually can distinctly remember you and I recorded a podcast, and this is quite a funny thing in the sense that taking a trip down memory lane here, as we recorded a podcast, I was on site at the time in a 2-hectare block of land that I bought in Lismore.
Yeah, I remember that.
Yeah. So
sort of on a hill.
On a hill. I literally was on the phone, and this was before the big floods that went through Lismore, first flood, then second flood. So before that. Now, this block of land, free and clear of flood, so thankfully I didn't get affected, but there was certainly a lot of people in that market who got dramatically and tragically affected, and some people lost their lives in that. And historically, Lismore in that area is a very flood-prone market. Now, if I ask you the question, Phil, after those floods, would you buy in Lismore?
Potentially.
You're a politician at heart.
Well, I think most Australian investors would say, no way, you're mad, right?
You're probably a bit more, wiser.
But the investor in me would say, well, you're talking about the northern rivers, right?
Yeah.
So Kempsey, Casino,
exactly.
Places
Ballina,
like that, Ballina, all that sort of areas. So I say, well, a lot of people want to live there and need to live there to support agriculture and other industries there. So therefore they need somewhere to live. So therefore there should be a demand for rental stock. So if you have rental stock, if you own investment properties in those locations in areas which are not affected by some of those natural inhibiting factors, i.e. are in a flood zone, I reckon you're probably on a good wicket.
Yeah.
Would be a glass half full view of it all.
Yeah.
A glass half empty would be, everyone's going to leave, they're all flood prone. You're not going to be
no one's going to set up shop again.
You're not going to get debt against it because you won't be able to insure it, all that sort of stuff. So that's a glass half empty.
And I guess if we extrapolate that to a bigger market, when we saw the floods go through Queensland in 2011, I do distinctly remember we bought a lot of property. Pure Property Investment bought a lot of property in Queensland, not in 2011, but probably more in between 2016 and 2019. And majority of the areas we're buying in weren't necessarily flood affected. However, the conversation about the previous floods was certainly point in case that people thought, well, no, Queensland's cactus, Brisbane in particular, Brisbane floods, I don't really want to touch it. And I guess the issue we have with perception versus reality, and I guess what I was getting at with Lismore and also with regards to Brisbane, is that Lismore, if we look at data and we talk about this Fast 50 report, there is 20% of these markets are potentially in regional areas. Lismore, not necessarily one of those markets, but if I look at the last bit of CoreLogic data that I have in front of me here, the highest, when I look at the highest level of annual growth, as well as the highest change in annual sales volumes, Lismore is in that category. Lismore's seen almost 100% increase in sales volumes in that time. Now, sales volumes invariably they translate to sale prices because the more property transacts, typically markets, especially regional markets, they typically can't build very quickly. So if property's selling, it means it's going into an undersupplied territory. And if I look at other markets that are in and around there, Gunnellabar, and there's a range of other markets, knowing full well that I personally own this, I've got a particular interest. Those markets actually do rebound. And I guess going back to this is that regional markets in general, they're much smaller economies. They're typically much more condensed. So what you've said earlier is that you've got to be careful. So I guess going back to one of those questions that we don't buy or do buy in certain areas, we're very selective when we do buy in regional markets. But you must look at historical components as to what's going to drive a town, upwards, sideways, downwards, as well as when the supply, the economy component really starts to kick in a gear, and when to buy and when not to buy. Because if we look at the worst performers over 2023 in general, as far as general cities and suburbs, majority of them were regional markets.
Yeah.
There were certainly areas across Tasmania which were the worst performing areas in Australia last year. There were areas in the south of New South Wales, some more affluent markets such as Bateman's Bay. Byron Bay was certainly one of those bottom performers of the year last year. Even markets that have always been bulletproof, certain areas a little bit further down, just past the Illawarra, Wollongong, Jirowa, Gerringong, these are very affluent markets. They were some of the worst performing markets in Australia last year. So I guess where we always consider is that you've got to find the time to get in, but usually when you're getting in at the right time if you're buying at a point in the cycle where you don't take all that risk. Buying at the top end, i.e. anyone who probably bought a property in Byron Bay last year or even the year before, or anyone who bought in the south coast of New South Wales, start of last year or the year before. And a lot of those affluent regional markets are probably at the point now where they might be thinking, that property has not moved. I don't have the same demand that I thought it had from a rental standpoint. Growth might be at the point in time right now where it will stagnate. But there are a handful of very good regional towns which will continue to prosper. And you mentioned markets such as Geelong, markets around the Sunshine Coast. There's certain larger areas in the South Australian market which are more robust, larger, longer-term economies, especially up towards places like Rockhampton, Bundaberg, Cairns. These are regional centres which have been the same for a very long period of time. Over towards the West Coast, basically had all of the best regional performing markets in Australia last year, and I suspect by the end of this year, regional WA, not mining WA, but regional WA, places like Albany, Esperance, down towards the Margaret River region, further up towards the Ningaloo market up there, you're going to see that those are the markets that will likely benefit better than anywhere else in Australia. But it's always cyclical, right? So we're not saying that those markets are going to sit there and be prosperous forever.
There's so many dynamics as part of this, and what we're really talking about is potential diversification of your portfolio, much like for those people watching on the video, the diversification of the shirts that we've both chosen to wear today.
You just noticed that?
Yes.
Mine's a twill, yours is cotton.
What's twill?
I don't really know, mate. Don't press me on those points.
Oh, God. But it's good to mix it up every now and then, is the point. The regional markets and metro, and again, it's a strange one, right? What really is a regional market? What is a metropolitan market? We spoke about Geelong, for example. I think it's classified as regional.
It is, definitely.
Even though it is metropolitan orientated, right?
Top 10 as far as actual volume of cities in Australia
cities.
now.
So if you look at Geelong, and I guess like a pigeon pair to that might be the Central Coast. Is the Central Coast metropolitan or is it regional?
I think it's deemed to be part of the Sydney Metro now.
Part of Sydney Metro.
Go to the Hunter/Newcastle, that's deemed to be a regional market. That is a large regional market, technically.
Yeah.
Yeah.
So it's not about classification. I think it's about the inherent complexities of these locations.
Yeah.
And by that, I mean the diversity of the economy, the diversity of the infrastructure, the diversity of access to all the amenities you expect, the livability of these places. There's some real hardcore regional markets. Like Bathurst is regional.
Yeah,
you
know,
know,
it always has been.
It always has been.
Hasn't changed.
No, but you've got these sort of hybrids. Call them hybrids, which are
Ballarat, Bendigo, Shepparton. You can name a few in Victoria.
Shepparton. A lot of bottle shops in Shepparton. Another story. So don't get too caught up in the lexicon or the definition of these things. You need to understand it. Now, capital city markets are easier to get right in terms of accessibility for the blend of assessing a suburb or a location's performance or fundamentals based on data versus the ground truth, right? And ground truth being, okay, this is what the data's telling me, but really what's happening on the ground. And the only really way to do that is to have a really good buyer's agent, you know, a pure property investor.
Or be there yourself.
Or do it yourself, right? So you can't invest in isolation or in a bubble of data if you're looking at regional locations. In capital cities market, it's easy going. You can drive around, have a look around, go to shopping. You do all that stuff. You go and chat to a local real estate agent. If you want to start investing in regional locations, you got to get boots on the ground, right? Otherwise, you're investing blind. Now, I look at this. This ain't a bad report from CoreLogic. It's called Regional Property Market Outpaces Capitals as Slowdown Hits Cities. So this is recent, right? This is 3 days ago.
Yeah.
Three days ago, right? So, but we've got to remember this is looking in data in the past rather than looking forward. The Fast 50 looks at where to put your money today for the best capital growth moving forward, right? So whether or not this will be the same moving forward, who knows? But you know, there's three key areas it looks at. It's got values of dwellings. It's got rents of dwellings. So two key areas plus some other information. So and the way they frame it is best performers and worst performers. Now, they've used certain metrics around it. So they've done this just on the data, right?
Yep.
They haven't done an overlay of
No.
sentiment, ground truth, all the other stuff,
Yep.
right?
And also some of those other components, like you said. So we've the Fast 50 report rules out markets which haven't had a certain amount of sales per annum. So some regional markets can have very, very small turnover and be very small markets. Inherently, we just don't include those because they're just too small.
They're too small. If it's under 50, we don't touch it. And when I look at say some numbers here, a number of properties sold across the Fast 50, the average was per suburb 184 was the average.
Which is a decent volume.
It's
of
a decent
sales
volume.
for a suburb.
Yeah, some are like in the 200s. Everything is above 50.
Yep.
There's one here in the thousands.
Yep. And this is
Baldivus?
Yeah, Baldivis.
Baldivus. See, I don't even know any of these
This is
places.
why you stay on that side of the mic and I'll stay on this side.
Yeah.
But I guess to the point of everyone, and the reason why we sort of, and the methodology there, it's quite important because whilst property, yes, it can be a great wealth creation vehicle, we speak about this very often, it's very illiquid. And the reason why turnover and volume of turnover is extremely important is that it's all good and well holding an asset that may grow in value, but at a point in time, if you can't liquidate it, it's as good as no good because if you can't go to the bank and get money out of it and all of a sudden you say, well, I can't sell it. And I can think of dozens of suburbs across Australia, regional suburbs more particularly, which people did their dough. And we go back to the mining boom. Phil, we've been doing this podcast long enough to talk about mining booms that were happening back in 2012, 13, 14, where suburbs like Moorumba and Emerald and Port Hedland were getting all the headlines, right? These are markets that were doubling within a year and had insane valuations, insane rental yields. And these are the people who got on there, but they didn't necessarily do this type of digging to say, what happens when? If the lights turn out or the lights turn off for a period of time and I need my money, if there's no turnover.
I need my money.
Yeah, how do I get it? Because if you can't sell it and the bank wants their money back because they can see that the market's tanking, that's why this report is extremely important in the methodology.
Yeah. And I would argue, and I'm sure there's property experts, I'm not a property expert, I'm probably more of a property commentator, but capital city investing, and this is a big generalisation, so, and I'm happy for you to contest it, capital city investing can be a lot more forgiving than regional property investing.
Yep.
If you get it wrong regionally, you're probably going to get it wrong.
Yep.
If you get it wrong in capital cities, you're going to get it wrong, but it will probably resolve itself over time.
Yeah. And I can, there's a lot
Agree,
of different
disagree?
examples.
Yeah.
No, I completely agree, mate. And I think that anyone who's listening who potentially has gone down the pathway of maybe buying, let's say hypothetically, an off-the-plan apartment in a major capital city, where my mind goes to there, and I'm speaking to dozens of clients a week, I can usually see 2 or 3 or 4 of these in people's portfolios every week that they bought that they wouldn't buy again. But, and I know actually I had Gerald from my team on a separate podcast a couple of weeks ago who bought an off-the-plan apartment years and years ago as one of his first investments.
I think he did all right at buying.
He did all right. He didn't do tremendously if you talked about what the opportunity cost to buy something else. So I guess what my point with that is, though, if you're buying those types of properties, usually the example is that you bought it, you paid a holding deposit, it maybe took 3 years to construct, you end up getting the keys 4 years later, and then you held on to it for another 5 years, and you look back over a 7 to 10 year period, and you're like, it didn't really do anything. It didn't go backwards, but it certainly usually means that, and mining towns, regional towns, you can, if you're jumping at the wrong time, where I find the bigger risk is that you're probably going to find that the opportunity cost long term is where, because you're usually entering into at a lower price. You're not buying at a Byron Bay $2.5 million purchase price. You're usually buying in because you're buying at a slightly lower price point. Yeah. So are you going to lose your shirt? Probably not. Are you going to lose big opportunity costs if you time it wrong? Yes, there's a lot more potential for that.
Someone that does regional buying really well is Simon Presley. He's from Propertyology. And Simon, if you're tuning to this, how you going, mate? Like he's got a particular way he looks at regional markets, and he's very numbers orientated, but he has a good balance of actually understanding what's going on. And I highly encourage everyone, like as part of your decision making process, to absorb your stuff with research like that. Simon's one of the experts on the panel to help us out with this stuff. So he's a good operator, and he has particular views around regional markets. But going back to this core logic report, Paul, and again, don't invest in isolation. And you're going to go to the Fast 50. You're going to see all these numbers, and we're going to chat in a couple of podcasts time, a couple of days time. What do you do now that you've got this market intelligence, right? It's about how do you take action. But looking at regional, looking at this CoreLogic report, and CoreLogic again is the engine of the data component of this is provided by our good friends over at CoreLogic. So thank you. Highest quarterly growth was Albany, 7.7%. Yeah, that's pretty good going. Highest annual, that's quarterly growth, right?
Yeah,
so go on.
Really good.
Highest annual growth is Bunbury, 15.8%. Good going.
Yep.
But what's happened over the last few years? Maybe as a catch up, who knows? You've got to look at the shortest days on market. Bundaberg, okay, shifting stuff. Lowest vendor discount, so which shows you where is the highest pressure on the speed of sales. Albany, again. But here's the place here. Highest change in annual sales volumes, 73% Lisbore.
Yep.
So there's got to be a story now. Is this people just dumping stock because they want out of flood-prone areas?
Well,
I don't know.
Well, but I mean, you'd think that that's 3 years ago, right?
Yeah.
Like, as in, if that was going to happen, that would have happened. The reality now is that where you're seeing highest change in annual sales volumes, that's sales volumes. That's not listing volumes.
Yeah.
So sales volumes technically means that it usually, if you're seeing an increase in sales volumes, and if anyone wants to start thinking about how to read data a little bit more intently, when you start to see a dramatic increase in sales volumes, i.e. people buying a property and putting pen to paper on a contract, that tells you that there is a change in sentiment and that market is actually seeing stock shifted. So if the increase in volume of sales is really pushing upwards, that's, if you're not seeing that coincide with listing volumes increasing at the same pace or stronger, then you're starting to think that, okay, what will happen is supply will drop off and pressure on the remaining stock basically continues there, and you see prices increase.
But I haven't been in Lisbon for a long time, so I don't know. But is there a whole bunch of new houses there that weren't there before that are getting sold?
Unfortunately not. No.
And this is the issue.
If anything, there's less. There's less because a lot of the markets there have now been all of a sudden ruled out to say, well, you can't build in certain areas because they're flood prone. So, unfortunately, turning over.
So there's
soil,
obviously a demand for investment
there is
stock
demand.
there.
There's demand. There's an economy that pushes a demand, and that's going to be a common story.
Are they moving to town? Do you know?
The town's, knowing full, I've still got a development side that's underway there. The town is probably back up to about 80% of where it was. But
so they've left it where it is?
Left it where it is. They're not going to move the town.
No.
There was discussion about moving the town to the top of the hill and relocating, etc. But when it comes down to it, it's the heartbeat of that area. And there's a certain element of, I guess, of charm when it comes down to that's the old town, and that's where people set up. And regional markets such as Lismore, and there's a lot of regional markets that are very similar. Yes, there's commerce that goes with shop fronts and things like that, but there's a much bigger story. You're only an hour away from the Tweed border. You've got a huge hospital that's gone up at the Tweed. You're only 45 minutes from Byron Bay. You're 45 minutes from Ballina Airport. You've got a
sounds
pretty
like you're going to try and start selling property there.
Not
soon.
at all, mate. I don't want anyone to touch it. That's my market. but I guess there is so many different Lismores across Australia. And to your point of what people like Simon and his team look at is that you're trying to find where are these little heartbeats and where are they undervalued and where's their opportunity. I think probably there's a couple of common themes there, though, and you mentioned a few points with Albany, which was one of the top performers from a quarterly as well as an annual growth component or lowest vendor discount. Place like Albany and annual growth was Bunbury was about just under 16%. What you've also got to do there, though, is you say, well, if that's the best performing regional markets, compare that to the best performing metro markets. And I know we talked about this in one of the previous podcasts for the Fast 50, is that if we look at the Fast 50 report from last year, Phil, I know some of those top 6 performers out of the 10,000 suburbs that we selected last year, some of those markets I can think of off the top of my head, markets such as Armidale was north of 30% capital growth in the past 12 months. There was a couple other markets in Perth which were, again, north of 30% growth. So they still outperformed. And if you look at the average purchase price, they're about the same. So then you've got to ask yourself the question, say, am I prepared to take the risk on a price point that is equivalent of a metro market property? And again, I'm not sacrificing a property type. I'm still buying a freestanding established house with a land component, and I'm getting potentially the same yield, give or take. Then you've got to ask yourself the question, where is the risk for myself more prepared to be taken? And am I going to be in a position where I can get above average capital growth or better growth and a potentially different option?
And that's the point I made around metropolitan markets are a little bit more forgiving.
Yeah, exactly.
And it's just general, I get it. But let's talk averages, right? So we mentioned what they were there for 7.7 quarterly growth, Albany, 15.8 Bunbury. They're overperforming. They're outperforming, right? It's a moment in time as well. And there's got to be a lot in there. But if you look at the Fast 50, so the Fast 50 report, here we go. Let's see how good you are. What do you reckon the median quarterly growth was? Average. What's the average of median quarterly growth
For all 50 suburbs?
for all 50.
Median quarterly growth, and this is talking about this is the
last
last
three months.
So basically the December quarter.
Yeah.
I'd have to assume it's probably circa somewhere between 3 or 4%, or maybe way off.
5.
There you go. Yeah.
And when you look at what Albany's doing over there, so
It's
that's
slightly above that.
absolutely outperforming, right?
Yep.
All right. What do you reckon?
Which is still great. I mean, if you're getting any of those top 50, you're getting 5% quarterly growth compounded, north of 20% over a year. You are doing cartwheels because that is a big return.
All right. Average annual growth, though. So I think that's 10 years, I think, is the average annual growth. What do you reckon it is?
This would be, I think this might surprise most people because of the weighting that there's over 50% of these markets are in WA, and because of what's happened in the previous 10 years, I think this actually will be low. I think it's going to be somewhere in that maybe 2.5 to 3.5% average annual.
4.7.
There you go.
4.7. And there's some outliers there, which have supported a lot of 8s, a lot of 7s.
Yeah.
Like Brizzy, for example, and Adelaide, those areas are skewed.
And a couple of Sydney markets.
You're absolutely right on Perth. If I do an average, here we go. I'll do this. If I do an average of 10-year average annual for Perth, it's 2.6%.
Yep.
And that's skewed by one location here, Brabham.
Yep.
Brabham was at 11.7.
There you go. And
So
that's
that's
more so because
skewed
it's a newer town and there would have been a lot more recent sales.
Yeah. So this is you got to look beyond the data, right?
Yeah.
So, and then for the 12-month growth, as in how much has it grown this December from last December?
Yep.
I guess that's what those numbers would be. What do you think?
Top 50 or just Perth?
Top 50.
Top 50? Oh, I'd have to think it'd be in the double digits.
Yeah, 11%.
There you go.
And if I do that for Perth,
that'd be more like 14, 15, 16, I would possibly assume.
13.
There you go.
13%. So you look at these numbers, you go, what? This is supposed to be some super duper report about where to put your money today for the best capital growth in 2025. They're the numbers you would expect for historic averages for investing.
Well, there's probably a couple of things there that are outliers, in my opinion. Look, if you're buying and holding for 30 years or the previous 30 years, average annual compounded growth in Australia was circa between 5.8 and 7.5%. If you bought a freestanding house, it was in the 7s. If you bought an attached property, it was in the 5s to 6s.
Okay, this is 11.
This is 11 annually. So to be honest with you, you're probably in the last 12 months, if you got 11, in the face. And if people listening and they hold property in Sydney or Melbourne in the last 12 months and they looked at the performance of that, I can pretty much assess that they would have got maybe that long-term average of 6 or 7%, maybe a little bit less. And over the last 2 years, probably less if we're looking at last 2 years. So it really does depend. But if I'm buying, and again, we're buying to say we want to get the best outcome, and this report is ideally trying to isolate which market's going to give us a well above average outcome for a 1 or 2 year period. If you're getting in that, we talked about Perth, 13% average. If you're getting 13% in that time, in a 12-month time, you're getting basically double the average. That's fantastic. Don't expect, though, that that's going to continue. And always expect that mean reversion. But again, the intention here is that if you can get that above average growth earlier in the cycle, typically what that allows you to do, pending your holding costs and your cash flow are still where they should be, this gives you the ability to expedite the build of your portfolios, i.e. recycle, reinvest the equity and build to the next market that's going to be giving you above average growth. And what we're trying to do is figure out how do you build your portfolio quicker, more aggressively, without taking the undue risk.
There you go. All right. Well, some insights there. I hope you enjoyed that, everyone. Remember, Fast 50 report. Go to smartpropertyinvestment.com.au. You can download it there. Hope you enjoy. Any feedback, editor at smartpropertyinvestment.com.au. We'll do a Q&A session in a month's time. Just to sort of break down a lot of the questions that we have. Hopefully we can sort of answer all those questions in the podcast we do in 2 days' time, which is sort of like tactical application. What do you do next around this? When we get together tomorrow, Paul, we'll chat around those suburbs that didn't make the list but are still good stuff.
Investable?
Investable. It's very much investable. Places like Wagga Wagga.
Meeting of two waters.
Places like Arncliffe in Sydney.
Jeez.
Do you even know where that is?
I do. It's right near the airport.
Yes.
So how's your geography?
It's pretty good.
Okay.
Pretty good in Sydney.
I thought you were about to say pretty good in the World War II battlegrounds.
That's also
Useless
pretty good.
information.
Also, Koondoola. I've never heard of that place before.
Koondoola? Is that WA?
That's Koondoola. K-O-O-N-D-O-O-L-A. Koondoola. Perth, WA.
Yeah, I thought it was.
See, no idea. No idea
Well, I
where that
said
is. What else is some place here I never heard of before? Tarralgon. Gippsland.
Trowgan. Jeez, Louise, Philip. That's where the dish lickers, mate. The Trowgan dish lickers.
Oh, the Trowgan dish lickers.
There you
St
go.
Mary's.
There you go. One of your hunting grounds?
Mate, well, I sold a place in St Mary's.
Oh.
But anyway, we're going to get into it. Stay with us. We'll see you again tomorrow for more insight interpretation, the big debrief on the Fast 50 for 2025. We'll see you again. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.